Are the bears going to claw this market down into the gates of hell? Or are the bulls going to send the market flying higher up into a stairway to heaven? To know which way this crazy kangaroo roller coaster market is heading, be sure to watch this video until the very end. This is not financial nor professional advice. This video is for entertainment only. Hey everyone, I'm Stephen Fox. Welcome to my channel where I try to use psychology of money to figure out what this crazy market is going to do next. And it hasn't been easy, especially lately. The market is showing signs that it wants to go forward, and then it is showing similar times where the bears are in control. And it just goes from the bulls to the bears. The bulls have been largely in charge since the beginning of the year, but there's bearish factors showing up all over. And so people are confused. What is happening with this market? What's going to happen with the market? You hear people coming out and saying, well, it's going to be a boom. You know, the market's looking out forward 6 to 12 months and things are going to be booming. And then you got the bears saying, look, we got the most predicted recession in history at our doorstep and it has to go down. And I think what's confusing and what's probably going to happen is I think we've had a boom at the beginning of this year. I think it's going to go bust at least somewhat. And we could go into a recession. But there's signs we want to look for to see what stage we're at. But after that recession, I think things are really going to boom. So basically we have a boom, bust, boom, which is depicted in this following clip.
Have you revised upward your target for the S&P, where, say, the 3,200 bear case isn't really at play anymore?
Well, look, the way we look at the world and the markets is we have a sort of a 12-month view, and then we have a shorter-term kind of tactical view. And on the sort of year-end target prices, we haven't budged those because we think those are still accurate. 3,900 is our base case for year-end, 4,200 bull case, and then a 3,600 bear case. Those are in place. Okay, those have not changed. The tactical trading path, where we've gotten wrong this year, is the timing of it. We don't think the path is necessarily wrong. We put those targets of 3,000 and 3,300 for a trough for this cycle in May of last year. Okay, so that has not changed. But we, calling the price and the time, I mean, it's hard enough to get one right. To get both right, I think, is tricky. So we've been wrong on the timing for sure, but it doesn't change our view that low end of the range, that path to 3,900, we think still goes through kind of low 3,000s ultimately.
So Mike Wilson thinks we have bearish times ahead of us. We just haven't gotten there yet. And the market is pricing in rate cuts. And people think that this is crazy on the one hand. On the other hand, it might not be so crazy as reflected in this next clip, because we cannot predict when things are going to break. And when you've raised rates this high, this fast, when things have already started to break, it's likely that they could break even more.
We're looking at potentially a 10-week high in terms of global equities in the close. Do you think it has much further to run, the rally in equities?
We are a bit skeptical on that, especially in the US. I think you've had a huge boost from yields, and the market has pulled forward a lot of that potential central bank put, which might not come, because if the labor market remains strong, if the economy doesn't have a recession, the pressure on the Fed to actually cut rates by as much as what the market is pricing is quite low. The market should price cuts, that's for sure, because you're late cycle and something going wrong is more likely than not. But at the same time, 100 basis points being priced, that's probably a bit too much, which means the rates picture might at some point become a bit of a headwind again, and that doesn't help US equities.
To be clear, when you say the markets are right to price in cuts, do you mean by the end of this year, or do you want to push that out to 2024?
So in terms of market pricing, We don't expect cuts until next year. But I think in terms of market pricing, it does probably make sense for the market to price already cuts this year. Because you always have to think in probabilities. And the challenge you have right now is that if something goes wrong, the Fed actually could cut very aggressively, just like they hiked very aggressively. So just a small probability of really large cuts means that the market needs to price some cuts. And from that perspective, we actually feel that it's not completely wrong that the market does price cuts this year already.
A lot of this hangs on what happens with inflation, and the consumer price index came out very favorably last time. It showed a large decrease, but the core inflation, the sticky part of inflation, got a little worse. So we're left in that valley of what's going to happen. We think what's going to happen is that the Fed's going to raise rates at their May 3rd meeting, and they may raise them after that, depending on what happens with the CPI in the next month.
The CPI report this morning showed headline CPI, or overall CPI, rising at a 5% rate. So what you're seeing there on your screen is the year-over-year change in the CPI. Now, you see starting in April of 2022, it picks up there. That was when we were seeing that 40-year high inflation. In June, the third bar there on your screen, that's 9.1% inflation, the highest we had seen since the early 1980s. And then you see that just consistent move lower over those following months. Now, what's really interesting about today's report is the actual month-over-month inflation only picked up 0.1%, and that was actually 0.05% increase. So really close to no inflation increase overall in the month. That compared to expectations for it to fall to 5.1% year over year. And that was down from the previous month when it was 6%. You see there in February, and then 6.4% you see there in January. So a kind of precipitous continual decline and decrease in the year over year pace of inflation according to the CPI. Now, I want to contrast that with what we've seen from core CPI. And that's an important indicator because it strips out volatile food and energy prices to give you more of a look at what the Fed can control, and one of the things that the Federal Reserve watches in terms of when they're looking at the market. So I want to put up here the CPI core chart. And as you see, the numbers don't go up as high. It remains around 6%. But then we still have seen since late last year, since about mid-year in 2022, those numbers kind of consistently coming down until you see that last bar there. CPI core picked up by 5.6% last month. That was the first increase we'd actually seen in the CPI core since September. And actually, CPI core was 0.4% month over month. So again, a bit of a worrisome trend here where you see consistently inflation had been falling, declining overall, and that continued, but core prices, stripping out again food and energy prices, which move significantly, taking those out, you see it picked up. So again, just wanted to illustrate what we've seen long-term and the differences between that CPI core report and the overall CPI report. CPI is doing what the Fed wants it to do, just come down, decrease till it gets to that 2% target. Core CPI, though, this month bucking that trend a little bit.
So the problems for the CPI are largely energy and rents and realty prices. And we have some good news. It seems that rents are falling, and while the Saudis and OPEC Plus have tried to increase oil prices, demand is going down severely. So their plot to increase the price of gas could work against them and reduce even demand for gas even more. It's going to work just the opposite of the way they thought it would work. The good news on shelter inflation is that the median asking rent fell by 0.4% in March to $1,937, the first year-over-year decline in 3 years. These 10 cities saw the largest annual drop in rent prices in March. Some of them are surprising, some of them are not. Austin, Texas had a lot of people moving into it in the last 2 years, so that's certainly good news. Chicago, that's sort of understandable. I was pleased to see that Phoenix, Arizona, which is near where I live, was made the list at ninth. But Las Vegas, that's somewhat surprising. Although, again, I think there was a lot of people moving there and rents got pumped up and then are dropping back down. Phoenix has always been a relative bargain and still remains a lot of bargain. But we have a lot of Californians moving in, and so that affected rents a lot, and they've come down somewhat, which is good to see. Other good news on inflation is that the world gas supply shifts from shortage to glut, with demand muted. I think the weather has been warmer than usual in Europe, and that's helped a lot. And they're uncertain how long this is going to last, but the natural gas price has gone down dramatically and just keeps going lower. This video clip is about a Wall Street article called "Gold Prices Near Record as Investors Bet Inflation is Here to Stay."
Investors have been piling into gold. The price is currently hovering at over $2,000 an ounce, and it has risen about 11% this year. The recent rise comes after the collapse of Silicon Valley Bank and Signature Bank in the US, and the takeover of Swiss bank Credit Suisse by its rival UBS. A late March sell-off in Germany's Deutsche Bank has also ramped up concerns about the financial system. But yet, gold has sparkled through the chaos. Investors value gold for its stability during uncertain times, and often look to the precious metal as an alternative to the traditional banking system. Here's one example of its recent appeal. In the week following the SVB collapse, net inflows into gold exchange-traded funds stood at roughly 14 tons. That's over $1 billion worth. For a couple of months before the collapse, investors had been pulling money out of funds. The recent banking sector turmoil spurred bets that the Federal Reserve will slow down its pace of interest rate increases. Over the last year, the Federal Reserve raised interest rates in a bid to tame inflation. These hikes made gold less attractive for investors because, unlike other investments, the metal does not pay interest. While Fed Chair Jerome Powell announced yet another rate rise in March, he hinted that it could be the last one for now, leading to a jump in gold prices.
We no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation.
Gold is also getting a boost from a decline in the dollar. A weaker dollar lifts commodities that are priced in the US currency, like gold. The precious metal was further boosted by a drop in the dollar in early April. That's after data released by the US Labor Department showed that the number of job openings dropped to a near 2-year low in February. A weaker dollar effectively makes the metal cheaper for buyers holding other currencies. Analysts expect gold to remain resilient. It has been performing strongly, remaining above $1,500 an ounce for the last 3 years. Weak US economic data and a sliding dollar has further driven up prices, solidifying gold's reputation as a haven asset.
A bullish factor they don't even mention in that short clip is Russia and China and other countries are buying massive amounts of gold to strengthen their currencies. That's a big deal. That's a strong driver of the price of gold. And right now I'm investing in NUGT, which is a double leveraged bullish fund on gold miners. It's not on gold itself, it's on the gold miners, which I think is actually a little more bullish way to invest in gold. And then you got the double leverage. So it's risky, but I think the times are right, and I like to move on something when the time seems right. So how do I tell what the market is likely to do in these uncertain times? One thing I look at closely is the value of the dollar. As the value of the dollar goes down, the price of gold goes up, and the stocks have been going up when the value of the dollar goes down. So that's factor number one. Factor number two is the VIX. The VIX is a measure of volatility. It gets higher when the market is probably going lower, because people tend to be more volatile in their buying and selling when the market is crashing or going down. Right now, it's phenomenally low. It's at 17. This is very bullish for the market. For me to consider getting out of this bullish phase, it has to go above 20. 20 to 25 is indeterminate, but the more it goes to 25, the more we're in deep trouble. Once it hits 25, it goes over 25, it's a done deal. We're going into recession. The market is going down, and I'll probably be using inverse funds at that point. But it has to hit 25 or be close to 25 and swinging strongly that way. And especially if there's a given catalyst, something that comes out of the shadows, that something else breaks. That's also probably the third sign that something serious breaks. In fact, if something breaks, that overrules everything and the market is going down. And I mean, a major bank going down would be an example of something that's sure to drive it downward. The fourth factor I'm looking at, and I will look at the jobs numbers. We have phenomenally low unemployment. Unemployment is at 3.5%. That's one of the lowest rates ever in history. You're not having a recession with 3.5% unemployment. It's not happening. To even consider a recession, we have to at least hit 4% and more like 4.5%, 5% before it starts to get really serious. And if we're going into a deep recession, those numbers should take off fairly quickly. But I think you'll be given some warning. If it goes above 4% and it's a strong swing in that direction and looks like it's headed for the fives, I think it's time to say, yeah, we're going into a recession and it's time to be conservative with stocks. That's all I have. Thank you for listening and watching. Be sure to like and subscribe. Hit the little notification bell, and I will plan and hope to see you in the next one. Thanks a lot.